Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Farhan bin Abdul Razak from KBA 2495A. This video is for subject MGT646 Quantitative Research Method, and the title for this research is The Factors Affecting Firm Profitability. Okay, for the introduction, although the profitability is the primary goal of all business ventures, scant attention has been paid to the factors that affect profitability in developing countries. A majority of companies, if not all, realize the concept and the importance of profitability, but they may not know how to enhance it and what the factors affecting profitability are. The annual financial statement provides an overview of the company's financial status and results, and thereby serve as the primary knowledge sources for the comparative analysis of how resources are used during the creation of value. The observe of relationship between profitability and characteristics of a firm are indicator of not only the effect that the independent variables exert on profitability, but also the effect of profitability on these independent variables. Various macroeconomic factors such as GDP, inflation, and market capitalization have been studied to see how they affect profitability. Extensive research studies on the effect of WCM on firm profitability have been conducted with diverse results. Okay, next we move to the problem statement. Several past studies have been examined the factors affecting profitability of firm, including size, working capital management, age of the firm, and leverage. A majority of companies, if not all, realize the concept and the importance of profitability, but they may not know how to enhance it and what the factors affecting profitability. In a crisis moment, it is clear that certain firms are trying to preserve their financial position through risky operations. However, this sort of action generally lead to worse financial position because of the limited experience and high risk. A majority of organizations understand the notion of profitability but may not know on how to improve it and what factors influence profitability. Profitability is often stated as the earnings of a firm which are generated by income after all costs incurred in a certain time have been deducted. Alright, for this research, the main research question is what are the factors that affect the firm profitability? And this research objective is to examine the firm level factors that affect firm profitability. Our scope of study is the scope of the study for this research is on the issue of the factors that affect the firm profitability. This research has set up a research setting in a range of public listed companies in Malaysia. This study has been conducted in years 2020. The method that has been applying in this research is the regression method. For the limitation of this research study is only the area of public listed company in Malaysia. This research study is also limited in using the regression method only and does not involve any other method. This research study was also deliberately limited in the year 2020 at the least. The significance of this research study is to find out the companies or organization can determine the factors that can affect their firm profitability. For the literature review firm's growth theory on firm profitability, the theory of the organization's growth and their profitability is known as a foundation for theoretical investigation on the act of company growth and also profitability. Many studies analyzing the drive of profitability in listed firms have recently been conducted, particularly in a specific areas such as banking, insurance, manufacturing, or real estate. The firm growth idea is based on the U-shaped long-term objective function produced by the several scholars according to evolutionary theories on corporate growth profitability entails corporate expansion. Okay, now review of the literature and research hypotheses. The first one is firm size. For big company, this is true that with the size of the company increasing, more resources are available, resulting in lower capital costs and significantly greater profit. In addition, firm size control the influence of policy and agency, cost on firm return on assets. The banking industry has biggest share of the financial sector. Companies may find it difficult to obtain sufficient capital to invest in capital expenditure. Based on the explanation above, the hypothesis is constructed as follows. Next is for liquidity. Liquidity measurements can provide information on the financial performance of the company in present and inform future financial planning. The most common measure of liquidity is the money gap or inventory conversion period, the time gap among both raw material purchase budget and completed product collection. The capacity of a company to easily transform asset to cash is identified as liquidity. Based on the explanation above, the hypotheses are constructed as below. For leverage, investors practice leverage to increase the return on investment substantially. Leverage is good for companies seeking growth, and investment are aware of this, but investors are particularly worried about the profitability of the company when financial leverage reaches a critical point. Based on the explanation above, the hypothesis is constructed as follows. Alright, for growth, in terms of finance, the growth firm means firm with unusually fast growth records in comparison to its competitors in the industry. Growth firms are often used in financial market among the most popular and widely debated firms, sometimes attracting controversial discussion among those who are optimistic or bear about the firm continuing prospects. Based on the explanation above, the hypothesis is constructed as follows. For company efficiency, economic Eugene Fama described efficiency of a market in year 1970, whose efficient market hypothesis EMH explained that an investor cannot surpass marketplace forces and there should be a market anomalies because they are being arbitrated immediately. As for operational efficiency, it is achieved in the financial market by reducing transaction costs and charges. Based on the explanation above, the hypothesis is constructed as follows. Older companies benefit from dynamical economic of scale by learning from expertise. A favorable connection may be anticipated between company age and profitability. But in the other hand, older companies may have developed ways of dealing with market changes that might lead to an opposite relationship between age and profitability. Even if something the listed age, the company age should be defined. So based on the explanation above, the hypothesis is constructed as follows. Okay, next we move to data and method. For data collection, in this data collection, the population organization of the unit of analysis used in this research study are public listed companies in Bursa Malaysia. So as for the resource of data collection, the data was taken from the databases that are used, Icon and DataStream database. Next, for the sample selection, the population that being researched in this research is in the Sharia compliant securities, which is under the sector of construction. The number of security involved as for the population of the public listed companies are 52 companies as at November 2020. So in this research, the number of population for public listed company for the Bursa Malaysia that can be referred based on the table of sample size given, which is 44 listed public companies in Bursa Malaysia. So these are the method of analysis. For the return on asset, the measurement is net income and total book of asset. For the firm size is logarithm of total asset. The liquidity is the current ratio. For leverage, the measurement is total debt or total asset. For growth, the measurement is turnover or sales. For the company efficiency, asset turnover ratio, and lastly age, the company lifetime. And this is the research framework that we constructed. For the independent variable is the firm size, liquidity, leverage, growth, company efficiency, and age. And the dependent variable is return on asset. Okay, for the regression analysis, the analysis method used is based on cross-sectional regression analysis. Regression analysis is a set of statistical methods used to measure the connection of a variable with one or more relationship between the independent variables. The best selection of the best regressive variable is the proof of their coefficient importance, and the confidence limit of the forecast constitute important practical matters. Alright, now we move on to finding and analysis. The dependent variable is return on asset ROA, and the independent variables are firm size FS, liquidity LQ, leverage LVG, growth GRWH, company efficiency CE, and return on natural logarithm of a number. This finding generated by the eViews software. The table below shows the result. Okay, for the F statistic, p-value of the F statistic is significant. At significant level of p is lower than 0.05. It indicates that the research model is acceptable. Alright, for this analysis, our findings that for the firm size is, according to the study, firm size has a positive and significant relationship with return on asset. Therefore, we reject our first hypothesis, which stated there is no significant relationship between firm size and return on asset. For liquidity, as a measure of firm liquidity, the current ratio and return on asset do not demonstrate any significant relationship. So our second hypothesis is failed, and the relationship between liquidity and return on asset is significant. The findings of our study are similar with previous research in 2019 and 2018 and 2011 and 2005, which discovered the leverage to be insignificant. Therefore, we reject our third hypothesis, which states that is insignificantly related between leverage and return on asset. Alright, for growth, based on the past study, the researcher found that there is a positive relationship between return on assets and income growth, indicating that any increase in the value of return on assets in general will lead to larger profit for companies. So next to the company efficiency, the study finding indicate a significant relationship between company efficiency and return on assets. So our fifth hypothesis is failed to be rejected since there is a significant relationship between company efficiency and return on assets. Lastly, for the age, this result in line in the finding in 2016 and 2009 who initiate that firm H had an insignificant relationship with return on asset. So based on our finding, we must reject our first hypothesis which state that H and return on asset do not have a significant relationship. And this is our regression model. So 1% increase in liquidity return on asset will increase by 0.026205%, and 1% increase in company efficiency return on asset will increase by 0.119092%. Alright, now we come to the conclusion. Based on the study using regression analysis, there are two factors, which is liquidity and company efficiency, that may be established as factors affecting firm profitability based on the six independent variables explored in this study. Liquidity and company efficiency are a factor that successfully determine the firm profitability of Malaysian publicly traded company. As conclusion, there are several aspects that control the firm profitability of public listed firm in Malaysia by utilizing independent variables from our prior studies. For recommendation, we like to suggest some ideas for possible features researcher on this area. The first idea is to replicate this study for a different group of companies. It can be different industrial segment or a more generic group, and thus compare the result with one we found for the construction sector. It would be really interesting to execute a qualitative research in order to answer how the firm managers observe the factors affecting firm profitability. If they observe a dilemma between this financial indicator or They think they are interdependent. Alright, now we have reached the end for my presentation. Thank you for lending your ears.